Okay, so we are currently here at Crowdestate. So could you introduce yourself and also Crowdestate as a company?
Sure, thanks. My name is Loit Linnupõld. I'm the founder and CEO of Crowdestate. I founded the company back in January 2014. So it took like 4 months to get our first project live. So we've been actively running projects since May 2014. So we've been around like 5.5 years. I think we are one of the largest real estate crowdfunding platforms in Europe at the moment. So if we consider the amount of transactions done and the number of investors, which are key metrics in that business. So that's the business. So,
all right. Okay. So you are a real estate crowdfunding platform.
Mm-hmm.
So for investors out there that are looking for to invest in passive income generating projects, why do you think real estate crowdfunding is a good choice compared to other assets that are more like classical, like investing in, like buying an apartment and renting it out, mm-hmm. or investing in the stock market, mm-hmm. or putting money at the bank?
Mm-hmm.
So why real estate crowdfunding is a better choice than those?
I wouldn't even put it like a better. Okay. I think it's an alternative, mm-hmm. and actually, like, I'm a believer that you should have a stock portfolio. So it's like not just a real estate portfolio. So I think like real estate could probably be like maybe up to 40% of the portfolio. Okay. Or there should be stocks. So I do index funds and stuff like that personally. Yep. So it's not better, but it's alternative. And if you put it in the context of real estate, then historically real estate has been a kind of playground for the rich people. And I think it still is. Like if you brought an example like buying an apartment, renting out, which is kind of a nice idea. When you run around Tallinn and try to buy an apartment, like a single studio, 20 square meters, the price is like probably like 70,000 euros a piece. So when you go to the bank says, okay, it's business property, so I'll lend you maybe 50% of that. So you should come up with 35,000 of equity. And if you're a smart investor, you want to diversify. So you probably want to have like 10 apartments. So you come easily to like having a need of equity of 350,000 euros, which like most people can do. And that's the problem. So I think crowdfunding can solve that one. So you can buy like incremental assets, whether it's a development, like we've been doing mostly development projects, but it can be a rental business, it can be supermarkets, it can be industrial logistics, like everything is pretty good. So you can buy a €100 piece in everything. You have just 1,000 euros, you have a nice diversified portfolio. 10,000, you have 100 projects. Works really nice. Mm-hmm. And if even something defaults or delayed or something like that, you really don't feel it then. So I think it applies to all other classes as well, like when you do consumer lending, like P2P consumer lending or invoice factoring. They're like, I think that different methods or like asset classes within the alternative as well. And I really like that. So you have a choice to this stuff that was inaccessible before. I think that's the beauty of the crowdfunding.
Okay, very nice. So there are, of course, a lot of platforms out there.
Even more popping up. Like we see probably like every month there's somebody starting a new crowdfunding platform. So it's tricky.
So how is Crowdestate better or different from those other platforms?
I think there are two angles from it. If you look from investors' perspective, we are one of the first guys in Europe who started like 5.5 years ago. We have pretty good experience. We have very nice track record. We are earning money from day one, so we have been always profitable. We are very well capitalized, so I think we have probably 1.5 million in equity, which is on our bank account. So even if we don't have any project for 2 years, we can still operate the platform, doing nothing. So for investors, it's really safe. Like we don't disappear. If you do it with a really early stage startup, I think the risk is there that the guys try it out. We see it that they publish the first project. They see it goes like really, really slowly. They collect 10,000 euros. They get like 200 euros as fee, and they say, that's not a business. So we do something different. So that's the risk for the investors. For the investors, probably the other good thing is that we have 37,000 international investors, which means that we have pretty good funding power. So the projects tend to be funded really quickly. So it's we put something up. Usually we do the funding like in a couple of days.
Yeah.
If the rates are lower, or the kind of, I think investors appreciate the high risk, high return projects more than low risk, low return. So if we do like senior loans for construction finance, they tend to move a bit slower.
Yeah.
But you would expect that there's no kind of, too much sitting around earning nothing. So it's good. For the real estate guys, our kind of the difference, I think the key difference that we are doing is we started off as a real estate equity crowdfunding platform. So the problem on the market was that the bank loans were available, but the developers didn't have enough equity to do nice and large projects. So we did like, I think 3 years, we were focused mostly on equity. We bought shares in the stock in the development projects, high risk, but the return target is 20 plus. So we have several examples like where the IRR is like 30-40% per annum because of the kind of successful projects. So it's and the market has changed over that time. So the developers are pretty well capitalized at the moment, and the problem is with the bank loans. So banks are not really ready to finance development projects anymore. So they probably overexposed. There's too much risk requirement. So the developers are struggling to find construction finance. So we have been doing a lot of that recently. So for the developers, the key proposition that we can say, we are like a one-stop shop. If you need equity, we can do it for you. If you need mezzanine loans, we can do it for you. If you need construction finance, like secured loans, we can do it as well. So it's a full, I would say, full capital stack that developers can get from our investors. And I think that's really unique for the compared to the other platforms. Okay. They are much more specialized. Some guys are doing just senior loans against collateral, and some ones are doing just equity. So it's, if a developer, you have to run around. We try to do like one-stop shop. We see the whole holistic picture of the project, and I really like I'm a bank guy, so historically, so I like to do capital slicing, see that there's always enough equity. If there's not enough equity, either we provide that to a certain extent, or we don't do the project. If the equity demand is filled, then we can move to the less, like a better secured and the low risk types of capital. So we do like capital slicing, and as a result of that, I think for the developers, the end game is like improving the return on their investment. Okay. And we've seen like if you have a standard residential development with equity return of 20-30% per annum. If you do like crowdfunding as additional layer there, you can increase it to 60-70-80% per annum for the developer, and that's very attractive. So it makes sense.
Okay, very nice. Let's now, you talked about risk just before. Let's now get in the, for somebody that's just discovering real estate crowdfunding, peer-to-peer lending, they just want to have some nice return on their money. The usual question I get from people that are new to this is that when you do invest on crowdfunding platforms, you basically play the role of a bank, right? Like you invest and you lend money to somebody else. So the question is what is actually the guarantee, so to say, that the person receiving this money, so in your case, people that want to develop some real estate, right, will not just run away with the money and never pay back. Right?
I think if you are looking again from investor's perspective, you should, if you're doing first investment, I would say there are two. You should pay attention to the platform first, what the platform does. So how much due diligence the platform does. There are kind of different models, so platforms are not equal. So some guys just publish everything that they see, like a marketplace type of, and no responsibility. And in certain Far East countries, it's the only model that's legally allowed. So it's like they just publish and connect the investors with the developers. You can't do anything else. So what we do here is all the project pass the due diligence process. Basically, we have a model that we apply. We look at the team track record. So if you don't have a team or track record, no funding. So it's like if you don't have a product that fits the market, no funding. So it's like we probably lose 2/3 or 75% of the projects during the process. So it's, and kind of the outcome of that, you sometimes see that there are a few weeks we don't have any projects, and that's because we kill most of them, because not really being a bad quality, but maybe having even like not a proper risk reward ratio.
Yeah.
There's some kind of question mark that we are not happy with. So it's easier not to do them than to do kind of a bad project. No?
Yeah.
So you should pay, like investors should pay to the platforms kind of due diligence process. Most of the guys who do it, they publish the process website. We do it like so you can understand what we look at, how the process looks like. Then you should read the contracts. Like a lot of people, they don't read the contracts, and the devil is in the details. So we have also like two different types of contracts. If you do equity deals, it's a variable interest, and the principal is not guaranteed and stuff like. It's kind of, but the return expectation is higher. But you should understand what you're buying. So it's not like even we say like expected return is 18%. It's not a fixed. It really depends on the project. It might be 16, it might be 22. So if we fund the equity type of project, basically we fund the business plan. So we like it, and there's a lot of variabilities that come to the influence the end result of that. It might be internal, like maybe there's a change in the construction price, or maybe the developer is able to increase the sale prices, or it's external. Maybe the market demand for the specific product kind of becomes smaller or increases. So I think no equity project has ever come out like as expected. They have come out like better than expected because of the market has been supporting that. But actually it might be kind of worse as well. So you should read that. And then if you have like a secured loans, I think the collateral is very straightforward. You have a security on a specific mortgage, you can have a security on the company shares, commercial assets, stuff like that. So, and this is written in the contract, so I would advise that you read the contract before you invest. Most platforms, they like us, they use standardized contracts. You read it once, you get it all. Like all others are pretty much the same. There are no kind of hidden changes there. So like we do the changes are on the first page. So if you see like what's the project, how it's structured. So read it through, think, don't rush. Like, make a sound decision. Like no platform, like we at least, we don't want to have investors investing into doing wrong type of investments that are not happy. They don't fit with the risk tolerance. So I think that's the worst thing that can happen, that they come back unhappy saying like, I really didn't know what I bought. I'm kind of pissed about that. So we really don't want that. So it's so that's kind of, in a way, I think, how would you say it? There's always a risk of fraud. So, and we have one case of that as well. So I think Kevade 9, which is, I think it's in collection for a few years now. And it's a nice example where, although we did the proper due diligence, we were not able to figure out that the guy represented some other guy. So it was a shadow shareholder. And after funding the project, the company was sold to the real owner. And that was a crooked businessman. And we have a first-name collateral or mortgage on the property, so we collect the principal and all interest, and I would say most of the penalties as well. So it's going to be a nice return for the investors, although it's going to be like 2 years later. I see. But this is something that there are always kind of these outliers that some guys are able to cheat the system. So it's a good learning point for us as well. Yeah.
And of course, diversifying many projects definitely helps in those
cases. And like risk-wise, like we have done like 200 plus projects, and we have done like very successful exits from more than 100. I would say if we do like 1,000 projects, definitely probably 10, 20 goes something, they go like wrong, and that's where the diversification comes into play. So don't put like your only 10,000 in one project. Definitely. Like we have like project every week, or like 2 projects per week, like 500 per project, and they're much more happy. Diversify across countries. We have like new locations. We have Italy, we have Romania, we are setting up Prague in Czech Republic. So you will have much more locations. So it's not stick to one market, one developer. So it's diversify, spread it around Europe. So makes sense.
Okay, very good. So what I did also before this interview is I sent a message to all my audience, and I asked what question do they have for you at Crowdestate, and I selected the 2 questions that came again and again in the answers. So we'll just go through those now. So the first one from the audience was, What is basically the primary reason or interest for companies that seek capital from you, right, for real estate projects, rather than going directly to a traditional bank? So why do they come to you and not to a bank?
I think there are a lot of reasons, and they depend on the company itself, but there are, like, I would say, few key ones is that if you're a trading company, for instance, like, let's exclude real estate development now. So if you're a trading company, a lot of the new companies, they operate on leased assets, like leased in the rented premises. They have machinery in the leasing, and they're looking for the working capital. And they have a nice kind of trade flow or production flow, but they have no collateral, so, which is kind of makes them no-go for the banks.
Yeah.
And the banks, they have a lot of kind of internal regulations as well, so they probably don't lend you if you are less than 2 or 3 years old. So if you have a very strong team, let's assume like you have experience working in a large company doing some specific product, and you quit the company, start doing the same business yourself, you have all the contacts, you know how to run it, and you'll figure probably how to run it much better than a big competitor. So you have a lot of competitive edge there, but you don't qualify. So it's kind of, I think, alternative finance. Of course, it's like riskier. So what we do, like we really don't finance startups. So it's like no go also well left. Although we don't draw the line like 2 years, so we're still looking at that you should have sales, you should have production, you should have employees on the payroll. So if you like have an idea, would you fund that? We don't do that. So this is one thing. If you look at the working capital, if you look at real estate projects, so the appetite has disappeared. So if you look from the bank's perspective, funding construction or the development part, it's the most risky part, because this is something where things can go wrong. Mostly it's like either the market changes or you have construction cost overflows. So you have to be experienced to manage both ones. So if you do a construction loan, you do like on monthly installments. So you hand money out like maybe 12 times, because the project is typically 9 to 12 months. And at the end of the first quarter, you're giving out maybe 15% of the funds, which are earning interest. So at the end of the project, when all the money is out and you're like, oh, now I'm starting to earn interest, the guy comes back and says, I've sold all our funds, I'll pay it all back. So it's like, there's a lot of work for the bank and no real financial interest to do it. So what they are much more focused on, they are funding the ultimate buyers, like mortgage loans for the private persons. Take out like 30-year loan, you get like one sale, 30 years of interest, really easy. Or the same for the commercial real estate. Offices, industrial buildings, you just conclude the agreement and keep it for 10 years. And then you roll it over for another 10 years. So it's like not too much effort, a lot of money there. And the money is always kind of goes out immediately. So
that's it.
Third part of it's like regulation, risk regulation. You have Basel 3 or Basel 4 is coming, so banks have to have more capital against real estate projects because they are considered to be risky. So and equity is the most expensive type of capital, so you have to allocate a lot of capital to tap that type of loans. So which makes them financially, like if you do this. How do you call it, the risk-adjusted capital, cost of capital or something like that, certain segments become unattractive. They need too much capital to be efficient. For them, it's like easier to say, like, we don't want to do that business. And that's okay, like, because this creates a very good market for crowdfunding platforms like Crowdestate. So it's like we can fill the gap back. So that's... and I would say it's not banks versus us, it's banks and us. Like we do a lot of projects with the banks, like, but recently, like the market has, at least in the Baltics, it has changed so much that in the development phase where we are active, they really don't want to be there. So it's like we are completing or helping the developers to complete the projects, and then they sell to the banks. So banks take them over with a cheaper and long-term funding. So, and that makes sense. Like everyone's happy in that.
Okay, right on. So the other question that came a lot from the audience is about the buyback guarantee. So on some crowdlending platforms, but mostly platforms that deal with consumer loans, or much smaller loans and not tied to real estate, a lot of them propose buyback guarantees, so meaning that they give back at least the principal to the investors if something goes wrong, usually after 30 or 60 days. It's quite rare in real estate crowdfunding for obvious reasons, but is that something that you have some plans of adding or something similar at least in the future?
No, it's straightforward. I think that this buyback guarantee is a bit like a marketing trick. So if you read that, I've asked some guys who say, like, yeah, that's a really good thing. I said, have you ever read your agreement? Like, is there written in that there is a guarantee, and who gives the guarantee? I said, no, I've never read my contract. So, and if you read, there's nothing written there. It's more like giving a guarantee yourself. So I could say that, okay, you lend the money to the developer, and if the developer is insolvent, he will guarantee that he will pay back. It sounds stupid. So it's, I think I would say, like, we provide great investments to the investors. Plain, simple, straightforward, no kind of tricks or hidden caveats. Like, no, maybe it works in the consumer finance where you basically the payday loan offices, they give it out like 100% per year or 50% per year. So that, and then they sell the loan to the peer-to-peer lenders at 10%. So basically they take out all the equity, most of the profit. Okay, they can give part of the profit back if it doesn't succeed. So it's maybe they have margin for that. In real estate, there's no kind of buffer for that. So it's very straightforward. So it's what you see is what you get. And if you don't like it, don't invest.
Don't invest.
Exactly.
Okay. Very good. So now, what do you see like the whole field of real estate crowdfunding growing as an industry in the coming years?
Oh, that's a kind of a good question. Because I think there's how would I put it? There are a few kind of big influencers that actually are going to mold the industry. There's upcoming European regulation. So I think that if you look at the current, let's speak about the European Union, so 28 member states, I would say half of them have implemented local regulation, local licensing. So if we would be willing to be present in all European countries, we should spend probably like, I don't know, maybe €1 million on licensing process, and then maintain those, 14 or 20 licenses, which probably cost another €20,000 a year, maybe 25,000, which is kind of expensive. So, and all the rules are different. So it's like for a single platform, it's very complicated to operate in such type of market, which probably is the reason why there are no very large pan-European players at the moment. But it's going to change. So European Union is working on a crowdfunding regulation. I would say it's 99.5% ready. I think the last reading of the consolidation round was early September. So my personal bet, it's going to be implemented in the next 12 to 18 months. And it's going to be a, how do you call it, European decree. So it applies similarly to all member states, and the member states cannot change it. So it makes a very not simple, but even playground in all countries, which would allow us to take a license in Estonia, passport it to any other country in Europe, which is cost efficient, and then you will have the financial supervision, which is good for an investor. So it's like all platforms are forced to play according to the same rules. Now it's a bit like a wild east, a wild west, and everybody does the business a bit like how they feel confident, and I think like leveling the ground and making, I would say, even in the competition is important. So everybody have the same rules, same options. So I think this is something that will result in stronger platforms to expand rapidly across Europe. So there will be some mergers probably, there will be some acquisitions, and I think like maybe 3-4 years there are going to be like 3 to 5 large European players that will cover like most of countries, offer a lot of investment opportunities like in different countries, have teams there. So investors sticking to those platforms have a lot of choice. So and we're going to be one of them.
Sounds nice.
At least we hope so. Well, everything in place to be one of them. So,
okay.
Yeah.
So maybe linked to that. So if you could share what are like overall plans for Crowdestate in the coming years as well.
No, we are running a simple business. So we are expanding. So like we have built, like we spent like €1 million on developing the technology. We have nice business model that works. We have proven that works well. It can be profitable, which is important for investors. The platforms are around for long term.
Yeah.
And now we are working on expanding into different countries. The lack of Central European legislation is, I would say, the key obstacle in expanding to different countries. We have, for instance, a lot of requests for funding from Portugal because they have structural problems there. Mm-hmm. Portugal has a local crowdfunding regulation. Mm-hmm. There are 4 platforms that are regulated. Licensing takes probably 12 months, which for us means that it's easier to wait for the European regulation before we expand there. So what we do now is we are looking at the markets where there is no regulation or the regulation is flexible. Yeah. So Romania, like Czech Republic, maybe Hungary is not maybe a good example. They have different problems there, but in Bulgaria, like Eastern Europe. So we try to get the foot there, hire some people. Our business model works in a way that we have always like a local team who can understand the market, who can analyze the project. So even if we are kind of smart guys here, I don't know anything about the market in Helsinki or Riga, even it's like 100 kilometers away. Yeah. It's a completely different world. So I need to have a local guy who is experienced in the market, knowing to analyze, knows the local people, local developers, who can source kind of good deals. And we start like that, and kind of our first step is always like having one person there, then it's kind of like who's analyzing and bringing in the projects. Then we add the local client support when we have enough customers there. So local language support is always important, and it's kind of very organic. Like we haven't raised any capital, so we are kind of internally funded. Yeah. So we have no pressure to kind of grow at any cost. So we do it like in a profitable way, smartly, maybe slower than the others, but we're happy with the pace. Yeah. So I think our capability is to open maybe 2-3 countries per year at this time. Mm-hmm. And if the regulation will be harmonized, we'll probably hire some more people so we can kind of spread out, like roll us out across Europe really quickly. Okay. But we have a model, we have processes, procedures. So it's like very simple copy paste. Yeah. Usually we do like legal, like a contract adjustments according to local regulation. That's kind of one larger step in the very early stage, but all countries are different, so you have to do it. So you can, use Estonian contracts in Italy or vice versa because it doesn't work. So, I see. So grow smart is a kind of key word for me.
Very nice. Yeah. Very nice. Okay, so thank you very much for this interview.
Thank you.
So what are the best ways for somebody who want to learn more about Crowdestate, maybe invest? What's the best way to find more about you online?
I think crowdestate.eu is a website. Come here, write us an email or chat in the messenger. So we have our customer support ready for that. So we are very responsive for that. So, or you can always come and visit us. So investors are welcome. Okay. So, but from those 37,000 investors, not too many have visited the office. So. Yeah. So I think Google is a great kind of, you can get reviews and all the stuff there. So it's, information freedom. Yeah. So everything's public kind of thing is hidden. So.
Okay, thank you very much.
Okay, thank you.